Well, some distribution here at the end of the day. I'm going to have to talk to some of my institutional friends and ask them to not make dramatic changes right before we go on air. But that's certainly what we saw today, right? Quite the accumulation leading up into the last half hour, and then we start to see some distribution again. So we'll take a step back, wrap up the week, and take a look at how today's action, this week's action, fits into the long-term trends. Ladies and gentlemen, this is the... Good afternoon, everyone. Welcome to the Final Bar. This is Dave Keller, the Chief Market Strategist at StockCharts.com here in Redmond, Washington. Thanks so much, everyone, for joining us today and every day. I know many of you have been with us every day for the last 2 weeks. Certainly appreciate it. And as always, very, very interested to hear your feedback on how we're going about this closing bell show for all of you. On Fridays, what we like to do is take a step back, sort of wrap up the week by making sense of the week's price action, try to connect it to the long-term trends and understand the big picture themes that we want to be paying attention to. As I mentioned in the introduction, it's funny how we've talked a number of times this week about the last 30 minutes, and looking at the chart really quick, just looking at the last 5 days, look at the last 30 minutes. 4 out of the 5 days, we had quite the distribution, and today, a lot like Tuesday, where we had a nice up day, feeling very, very good, and then all of a sudden, a ton of distribution. We closed almost at the lows of the day. Now, again, if you're familiar with it, right, the first 30 minutes tends to be, more retail investors, a lot of reaction to overnight news, earnings, and so forth. The end of the day is when big institutions are able to start to move some of the volume that they need to. So when you see big moves, big swings in stocks toward the end of the day, that's profit taking or accumulation by big institutions. A lot of volume that's gone in here. So clearly some profit taking here at the end of the day. And again, we've gone back to, gapped up at the open, just about 296, right above there for the spiders, and we closed right back out to that same point. So let's take a look at the S&P 500 and just look at how this fits into the big picture. So here was today, and again, as we're prepping for the show about an hour ago, I'm wondering how high we're going to get by the close. We're going to eclipse the previous highs. Everything all of a sudden looks long and strong up and to the right, and then we sort of have this pullback. So still plenty of accumulation on the day. I mean, it was certainly more of a sign of demand versus supply with a jump out of the open and the rally higher. That the end of the day is what sort of created the candle kind of coming down like this. So if you're a candle aficionado, if you follow candlestick analysis, depending on how you read this, it could be more like a shooting star candle where you have the open and close toward the bottom and a higher upper wick or upper shadow. That's sort of the high-low range. And in general, tends to be short-term weaker versus stronger. But again, sort of a strange end to the week as we sort of make sense of it. But again, as I've always reminded you, remember the point of looking at charts is to understand the long term down to the short term and everything in between, right? Making sense of the price action and how it relates to your investment horizon. And again, there's no doubt that the long term trend has been positive. It's been very constructive. Still plenty of plenty of positive signals looking at the long term weekly chart. Let's look at the trading, how it played out into the close today, and just try to think of the big picture with the week. So the Nasdaq ended about 136 up percent wise, and the S&P just above 1%. Canada flat to down for the day. In terms of major indexes, we had transports up. One of the things that was really interesting that sort of completed there is if you look, the small caps and mid caps actually led the way up, which is very different than the pattern we've seen previously this week, right? We've talked a lot about how the mega caps, the S&P 100, tended to be at the top, and then you had small and mid at the bottom, and that certainly started to reverse today with more of a bullish configuration. Looking at the sectors, we have the MEI trade at the top. That's materials, energy, industrials, all three sectors at the top of the list, followed by financials. Technology had been much higher. I think that's where there was a lot of the selling at the end there. It was up here just a little bit ago, sort of finished in the middle of the pack. Down at the bottom, we have the traditional defense. So consumer staples, real estate, utilities, all down on an absolute basis for the day. At the industry level, oil services actually the number one sector, up all over 4%, excuse me, followed by semiconductors and retailers. Semis and real retailers certainly more of the traditional offense. That's where we would look for, traditional offensive thinking of offense versus defense and where people are making their bets. The fact that those are stronger rather than weaker certainly speaks to, some positive signal there. On the downside, again, the only industry groups on this breakout, on this list that were down were REITs or real estate, and then gold actually down over 0.5%. So we had some guests earlier this week talking about gold, talking about the overall patterns, and certainly in the last couple of days, that's been at the bottom of the list, suggesting a move away from that sort of traditional safe haven. The big story, obviously, big picture-wise, has been the trade talks with China, sort of the relationship there, the FXI. An interesting chart has actually played out very well, quite the gap higher. One of the tweets I sent out earlier today was just looking at China. So again, the charts are really important to look at, even in the face of big macro sorts of news flow that's causing things to move, right? The charts don't tell you why something's moving, but they tell you how people are voting with their feet, with their emotions, with their capital. And that's why the charts are so helpful to relate it to what you're hearing on the news wires, what you're hearing from commentators and so forth. So the fact that the FXI, one of the big China ETFs, gapped up on the day, right up to the 200-day moving average, traded just above it midday, but, back closed below the open. It was part of that distribution toward the end of the day. So, it would be interesting with something like the China ETF going into next week. Do we see some sort of upside follow through? Do we see further, potential upside? And in particular, this high around 42 is really the key one you want to look for there to see if we're able to go above there or not. Just finishing off with the interest rate markets today, the TLT down 1.2%. Let me just resort these real quick. The high yield ETF up the most, up 0.4%, down to the IEF and the TLT. Those are sort of the regular treasury ETFs. And the TLT, definitely the most widely followed, the most liquid out of all of them, down a good amount. We're going to look a little later at stocks versus bonds and how we've had a real rotation to the downside there. That's one of those big picture patterns when you're thinking about asset allocation that you certainly want to pay attention to. Last, real quick, as a market recap, this is a chart we've been looking at a great deal, which is just breadth. And again, what I wanted to point out to you is even with the jump in stocks that we saw today, still, 60% of S&P names above their 200-day. That's up a little bit. Looking at the percent above the 50-day, it's right about at 50, which means it's half and half. Half of the stocks above, half of the stocks below. So overall, still sort of that indecision, still sort of that sideways sort of pattern in terms of stocks above or below that key sort of short-term differential, the 50-day moving average. So that's a recap to the week. That's how I'm seeing things sort of play out. I want to transition now to the Final Bar mailbag. As I've mentioned to you a number of times, you can get us on email at thefinalbar@stockcharts.com. You can get us on Twitter at FinalBarSCTV. Love to get questions from you, and a number of you have been sending in some very thoughtful questions. Really appreciate it. And anything's fair game. Things on the markets, things on technical analysis and approaches, things on StockCharts.com, and just how to use the platform. And again, the questions that I think will make sense in the terms of the show will certainly surface and start to talk through them. So a couple quick questions that I received today or recently. One was on volume. Someone asked, can you talk about volume and how you use it? If you've watched the show for the last couple weeks, this is the end of our second full week of the Final Bar, you probably have noticed very little to no use of volume on my charts. And that's not an accident. That's something that when I was learning the technical toolkit, 19, 20 years ago, I spent a lot of time thinking about volume, looking at the money flow indicator, looking at tick data, things like that, just trying to unpack from short-term to long-term how you think about volume. Over time, I've sort of gotten away from that. And again, I started in early 2000. And so that's right when we were still kind of processing decimalization in the US. That's when, the whole thing about dark pools and high-frequency trading, none of that was playing out yet. And as things have gone on, essentially the volume picture, in my opinion, has changed. So years ago, 30, 40 years ago, when you saw a stock move and you saw a huge amount of volume, you could draw a direct conclusion from that. This meant that the stock was moving up. There was a ton of volume, which essentially implied that big institutions were accumulating a lot of shares. And that's what you could assume. Now, of course, the volume, this composite volume figure can mean a lot of different things, right? It could mean two hedge funds just trading a bunch back and forth between each other. This does capture all the volume. So a lot of people are worried that they're not seeing it. The composite volume feed does get all the reported trades across all exchanges. So you don't have to worry about that. But I think the question is just what the volume picture means. So how would you think about volume and how to do it? So number one, I mean, the general, most simplistic thing I would do, and this is the John Murphy chart style. If you've not seen this before, I think when you create a new login, you should have one of these. If you click on chart style, go down here at the bottom. I have a ton of these, but you'll get down to sort of the StockCharts experts chart styles, and you'll see the John Murphy, and this is what it sort of looks like. And he does a great job of putting the color-coded volume. So on an up close, the volume is going to be green. On a down close, it's red. So what's helpful is to sort of look across here and see what the stock does versus the volume. When you have big spikes in volume, or those on up days or down days. And in general, if you look at this example with Target, just look, when it's in more of a bearish phase, you'll see a lot of the big volume days are on down days. Those are gap days and potentially earnings, but could be anything. And you can see that that's, telling of more of a distribution versus accumulation. On the opposite side, when you see the stock in more of a positive phase, you can see how the big volume days are on up closes, right? Because there's big accumulation that happens, and some people are coming in size and accumulating a lot of shares. So that's the very simplistic way that you think about it. The other thing that I would point out, and someone asked specifically about on balance volume, that's the second thing that I would recommend you take a look at. So the problem with, or the challenge with looking at individual volume figures, is you're drawing a lot of conclusions from one single day, right? So this was a day when you just had a little, the open and close were not that far off from one another, and all of that volume is considered positive volume. It's glowing green just because we closed up on the day. But during the day, there's actually a lot of up and down trading that's happening, right? All of that volume is not necessarily positive. So there are different ways we try to look at the volume trends over time and just try to see what is the price doing, and then what is the volume picture. Overall, are you seeing signs of accumulation or distribution over multiple days, multiple weeks? And that's where on balance volume is a really interesting indicator. What it essentially does is takes each daily volume read, quantifies it or classifies it as either positive or negative, and it's basically a running total, a cumulative number of those daily volume reads over time. So instead of just looking at one day's trading and saying, yep, that's a lot of bullish volume, you're actually looking at the volume periods, over day to day, over multiple days, multiple weeks, and sort of aggregating all that volume and sort of showing that. So in general, when a stock like Target is going higher, it's breaking to new highs, it's outperforming, on balance volume confirms that with a break to new highs, which it has not quite done. That's more of a positive signal telling you that there's accumulation on stronger volume. What you want to be concerned about is if a stock is breaking to new highs and it's not confirmed by a breakout in the on-balance volume, because that tells you that prices are going higher, but there's less volume on those up days. Otherwise, the cumulative number would be pushed higher. So on a stock like this, great to see the price breakout, and Target is the top ranked stock on our Scooter ranking at the close here when I looked a few moments ago. But the on-balance volume not quite confirming it, very, very close. We'll see next week if that confirms it to the upside. That would certainly be an interesting signal. So if you look back here, like in May, June, right, we broke two new price highs, confirmed with a positive breakout on the on-balance volume, long and strong up and to the right. So that is the answer to how I use volume. There are a lot of different ways to use volume, including things like the Wyckoff method, which looks at price volume relationships, and people like Bruce Frazier and Roman Bogomazov, are both experts in that Wyckoff methodology, and we'll hope to circle them back in to give some color as well. Next question I was asked about was relative strength, and it's perfect to have this chart up here looking at relative strength. So I will just very briefly explain, relative strength on the institutional side is probably the number one most important indicator, because we would always joke that's the line you eat. So getting the price right is fine, but you are paid as an institutional investor, as an institutional analyst, by owning stocks that were outperforming where this line was going higher, and not owning stocks that were underperforming or underweighting those. And so the idea of owning outperformers and underweighting underperformers is how over time you tend to outperform as a fund. So in general, when we're looking at a bunch of stocks, we have this indicator which is just showing the ratio, the simple ratio of target versus the S&P 500, and it's normalized from the beginning of the chart to show you the cumulative percent return from point A to point B. So I can see that over this 1 year period, targets outperformed by just over 28%. In general, you want to be owning stocks where the relative strength line is appreciating. You want to be underweighting or not owning stocks where the relative strength line is going down. So if you're an individual, how should you think about relative strength? Well, I would encourage you, if it's not an indicator you have on your charts, I would definitely encourage you to do it. And the reason is because all this tells you is, are you looking at the right chart in the first place? A lot of times we get so busy analyzing the chart, analyzing the indicators, following our checklist, coming up with a buy-sell decision, but we're not paying attention to the relative strength line. And if you have a period where the relative strength line is flat, all this means is the stock is fine, but it's a market performer. It's doing essentially the same thing as the broad S&P. You could just buy an index fund and go to the beach and not worry about stock picking, right? So the idea when you're owning stocks, looking for stocks that are making relative breakouts, that's where you're trying to identify stocks that are going to help you do better than just a passive investment product, right? Just better than just the S&P ETF or the diamonds or something like that. So in general, looking at this line and looking if the stocks that you own are outperforming or underperforming is a really important exercise. On your candle glance charts, it's an interesting way to use the candle glance system. Make your default candle glance chart one with relative strength. Look at your entire portfolio on a watch list. You can very quickly identify if you're owning the right types of names or not, based on what's working relative to other stocks out there. So, as institutional investors, it's programmed as part of your DNA, it's part of your thought process. I found with individuals, it usually doesn't surface up as much as it should, which is why it's important. So 2 closing comments there. Number 1, the way you apply relative strength is go to the indicator section, do price performance, and then just do this little guy where you have the ticker, the colon, and then the benchmark. So you can just put the spiders or the S&P index, and then anytime you change a ticker, it's going to change the one on the left to reflect the new stock you're looking at. And I would also point out that the relative rotation graphs, the RRG framework, that Julius de Kempener is such a fan of. He was the designer of this. This is all based on relative strength and based on those relative lines for hundreds, thousands of stocks and sectors and so forth. So it's certainly part of the way you should be thinking about it. In future shows and in webcasts and such, we'll definitely do more to sort of unveil this relative strength methodology, how to think about it. We're going to take a quick commercial break. We'll be back to wrap the week. Back in a minute. Welcome back. Welcome back, everyone. This is Dave Keller, Chief Market Strategist at StockCharts.com here in Redmond, Washington. Thanks, as always, for joining us after the close to unpack the action from a technical perspective. I want to thank all of you putting questions in the chat room. We're not going to get to everything today, but everything you put in there, we'll capture it. And in future shows next week and beyond, we'll make sure we hit those questions. So thanks so much for sending your comments in. I did want to address one of the questions was, about the price action today. We just sort of recapped the day's trading. And it's a perfect wrap the week type of question. The market ended a little more disappointing. Can we trust today's technicals until the news is clear? I love the way you phrase that question. Can we trust today's technicals? And, one of my mentors, Ralph Acampora, would tell you that is the only thing you can trust, right? The chart, the prices, you can't restate price, right? Something happened. Shares were traded at a certain point, at a certain price level that cannot be restated. It cannot be removed. And a lot of fundamental data, fundamental news, and everything can be backed up. Or backed off from. It can be changed. It can be edited. But price happens. Price is really the only factual data you have out there to really understand. Everything else is just guesswork going down the road. So I would argue that now is a perfect time to look at charts because it quantifies what people are thinking, how they're reacting, how they're interpreting all of the news flow that you and I are seeing out there about China, about political issues, about the Ukraine, all of these things that sort of fit together in this mosaic that we're trying to invest in. The charts will tell you where people are voting, right? And fear and greed will manifest themselves on the price chart. So I would argue, yes, it's a perfect time to do it. And it's very, very good, especially with something like the FXI. I would say it's a great time to look at it because you can identify levels at which people are going to start to reconsider their positioning. And that, along with what you see on the geopolitical side, can be really, really a meaningful way to use the price charts. So thanks again for the question. Keep them coming, everyone. Thank you. Want to wrap the week, and again, as we thought about how to approach Fridays, right? It's sort of the end of the week. We've got the weekend coming up. We thought about making it, more of a wrap-up session. How do we just connect to the long-term trends? So what I'm going to use for this segment is the Mindful Investor chart list. And again, if you've not seen this or you don't have access, just shoot us an email, thefinalbar@stockcharts.com. I can send you a link to this. You can bookmark it. And as I update charts, as I add and subtract things, you'll see it reflected on your login as well. But essentially what we're going to do is just walk through these and pick out some of the themes, how it's played out during the week. So I like to always start with the long-term trend. This is sort of my go-to weekly chart, looking at the last 5 years of price data going back to 2014, looking at the real long-term trends, understanding where we've come from. And again, it's been a very constructive trend. Here we have the cyclical down move in 15 to 16. We have the correction, the sell-off the beginning of 18 and the sell-off into the December lows of last year, and then the rally that we've been on since then. I look at the 21 and 34-week moving averages, and then this is the PPO line, which is essentially just showing you the difference between those two moving averages as its own data series. So as long as this is above zero, it tells you that the very long-term trend, the secular trend, is positive. And again, recently over the last 6 weeks, with all the volatility, with all the fluctuations, with all the uncertainty, the trend has still been positive from this longer-term time frame. So be comforted that even with all the unsure reactions, all the uncertainty about price movements, the trend has been positive. That is undeniable by definition, up and to the right. This is the the weekly MACD, or in this case, it's actually the PPO, which is pretty much interchangeable for the most part. The values are a little different, but you can kind of think of them the same. The PPO actually gave you a sell signal back here at the end of July, beginning of August. And what that essentially means is that cyclical trend, that shorter term time frame, has actually turned more negative. And so that's the indecision, the sideways movement that we've had. That's why this long-term trend is still positive, but sort of the shorter term trend a little more negative, right? And as long as the MACD line or the PPO line remains below the signal line, it just tells you in the short term, it's more negative than positive. And if that would break higher, which you'd certainly have to have more of a follow through than we did this week, it could potentially turn positive and signal further upside. This chart in particular, the breadth by cap tiers, we reviewed a number of times this week, and I want to just take a look at where we're at now. And this is the S&P 500 daily close, and then it's the breadth. So it's the cumulative advanced decline line. So every day, what's closing up, what's closing down. You take a running total over time, and that's what the green line represents for the S&P 500. So it's a limited universe. Then we have the broader New York Stock Exchange. Then we have the mid-cap index and the small-cap index. I just color code these manually just visually to represent whether the breadth is leaning more positive than negative. And one of the themes we've seen, which certainly has played out this week, is how the breadth on the S&P has actually remained relatively stable, relatively positive, while all the other measures have rolled over, right? And if you look at these three red lines, that's the breadth on the broader market, that's the breadth on the mid cap, and the breadth on the small cap, all rolling over below the support level that I sort of indicated. Some of these and the mid cap and then the broader NYSE testing that level, and if it would break above into next week, I'd switch them to green, suggesting that it's leaning more positive. But overall, you can see more distribution the further you go down. Someone actually asked me about how the S&P and the New York Stock Exchange numbers can be so different because they look, directionally, they're moving a little more differently. Remember, it's an equal weighted measure. It's looking at the number of stocks up or down. So this is taking a much broader universe, thousands of stocks versus just 500. So it's a little more skewed by the mid cap and small cap parts of the New York Stock Exchange. That's why it looks more closely to the others. Another measure of breadth we've talked about a lot is the stocks making new highs and new lows. And the overall trend that we've seen over the last 5 or 6 weeks is this weakening of new highs. And even this week, no different. So this is the last 5 days of trading here. You can see that every time that the market moves higher, less and less stocks making new highs. So I could easily extend this pink line a little further and sort of show this continued divergence, right? With, if the market's healthy, if all is well, you would want to see this breaking out. And a stock like Target that's at new price highs today, you'd want to see a lot more of that. And the problem is, if you look at this percent of or number of stocks making new highs, there just aren't that many that are actually breaking out. Today, for example, you actually almost had an even number on the NYSE of stocks making new highs or lows. And in the S&P 500, actually very few, just a handful of names that were on either. So we're all sort of in the middle of that range. It's sort of the indecision that a lot of my guests talk about this week really has played out on the charts. So we're sort of in that, could go up, could go down type of period, to be honest with you, from the charts. Wanted to finish off just looking at a couple key ratios. These are the key indicators I've looked at for years just to get a read below the hood one level. When you're thinking about sectors, when you're thinking about rotation, where are institutions making some of their bets? Here we're looking at a ratio of consumer discretionary to consumer staples. We look at this chart very regularly. You can see that the trend has been down. So even with the market recovering, either with the rally overall this week, again, this ratio really didn't go up a ton. A lot of this was today, where consumer discretionary outperformed staples, maybe yesterday probably as well. But overall, still in a downtrend of lower peaks. We had a little bit of a higher low here. So if you see it break above to new ratio highs, that would suggest maybe more of a rotation. We haven't seen it yet. The final one I want to show to sort of wrap up the week is the relative performance of semiconductors, something we've looked at very regularly. If I had one chart to sort of give a tell at the sector industry level, this is the one I'd look at, just because in general, if you own stocks when semiconductors are outperforming, you tend to do pretty well. When you don't own them, when they're underperforming, you tend to stay out of some bad positions. And overall, the ratio has gone above the trend line, potentially now to new relative highs for the year, which is one of the sort of all clear signs we've been looking for. So going into next week, those are some of the themes that I'd want to unpack and pay attention to. To finish off our show today, we're going to wrap up with the 3 and 3. Every day we look at 3 and 3, and again, this is the idea of looking at 3 key charts. If you take nothing else away from our discussion, what are 3 charts that, if they're not on your radar, they certainly should be? These are charts that I hope you recreate on your own login, save into a chart list, and keep following them every week. And I think you'll overall have a really good sense of where we're at. So the first one is the one we just finished with. It's the relative performance of semiconductors. And again, for me, it was very interesting. I had this trend line on since we sort of set the secondary peak back here in August. Since then, we sort of lined up very well with that into last week. And now, just with today's price action, have broken above there, sort of confirmed a breakout of that downtrend on the relative performance, and arguably are to a new relative high. I'd want to see next week if that continues to break out or if we find sort of a stable resistance level. But again, it tends to be a pretty good leading indicator for stocks, more broadly speaking. The second chart, as part of the 3 on 3, is the ratio of stocks versus bonds. Another one we've looked at routinely. This is the spiders, the SPY versus bonds, the TLT. And again, when this ratio is going up, that means stocks over bonds. When the ratio is going down, stocks are underperforming bonds. So the way we're showing it here is certainly more of a short-term measure, looking at risk on, risk off, on a shorter time frame. But again, looking at the longer-term trend, you can see this overall rotation away from stocks. And again, you think of the chart of the TLT, chart of bonds, right? I mean, they've been so strong and have gone, just exponentially higher over the last number of months. And that's why this ratio overall has been sloping downwards. This is what happened this week, though. Look at how this reversed. This is the line we looked at going into last Friday, and now we've completely gone up. I probably this weekend, when I'm looking at the charts on my own time, I'll probably put a green arrow indicating that rotation more to the upside. But it's certainly something to watch going into next week if we see a follow through there. And then finally, looking at individual names, we didn't talk too much about those today, but there are a lot of really interesting themes that have emerged. Stocks and groups that are breaking to new highs, not just semiconductors on a strong relative basis. Home builders are a theme we didn't look at visually today, but really good if you look at the XHB or one of those home construction ETFs, really, really strong. This is Target, which is now the #1 stock out of all the large cap names in the scooter rankings. It's now #1. KLAC, which had been #1, is now #2. Overall, breaking to new price highs, new relative highs. Little extended on the weekly chart, overbought, but overall on a really positive configuration. So that's the 3 and 3, the 3 charts to keep in mind going into the weekend. Want to thank everyone for joining us today on The Final Bar. Again, this is every weekday, 4 p.m. Eastern, 1 p.m. Pacific, connecting the short-term price action to the long-term trends. Email us with any questions, any feedback, thefinalbar@stockcharts.com. You can also get us on Twitter @FinalBarSCTV. Got some really exciting stuff next week. We'll be on the road in Minnesota, interviewing Ralph Atkampora, Craig Johnson from Piper Jaffray, some really talented analysts. Have a fantastic weekend. We'll see you next week.